Hello and welcome to Laguna Eye Capital segment on banking, the expenses section. The banking industry, what the majority of us use to better ourselves in society, as well as the ones that use us to grow from. If you seek to get a house one day, you seek to have savings, a brokerage account, or any situation that consists of over $500 in transactional value, you're going to be needing or typically associating with a bank. There are many different banking options, but typically there are three: the large banks, credit unions, and your typical shoebox or other miscellaneous saving based applications. So, what we love to talk about is a credit union. A credit union is a type of financial cooperative that provides traditional banking services ranging from small in size, volunteer only operations, to large entities with thousands of participants spanning the country. Credit unions can be formed by a large corporation, organization, or other entities for their employees and members. Credit institutions are created, owned, and operated by their participants. As such, they are not for profit enterprises that enjoy tax exempt status. So, the credit union follows a basic business model. Members pool their money together. Technically, they're buying shares in a cooperative in order to be able to provide loans, demand deposit accounts, and other financial products and services to each other. Any income generated to use or fund projects or services that will benefit the community and interests of its members will be from a credit union. So, some of the key takeaways: credit unions have fewer options than traditional banks, but offer clients access to better rates, more ATM locations because they reimburse you on fees. They're not publicly traded and only need to make enough money to continue their daily operations. Thus, they return it back in higher savings accounts or better opportunities and rates based off of loans that you ask for. However, credit unions have considerably fewer brick and mortar locations than most banks, which can be a drawback to clients who like that in person service. Credit unions also are exempt from paying corporate income tax on their earnings, thus, grander and better saving rates for you. Now, what about looking at the big boys? Banks like Wells Fargo, Bank of America, Chase, and many other ones that continue on. You may need a house or a loan, and this is your best bet is a bank for a car loan, a mortgage, whatever the situation is. Building service and repetition within the bank and banking service, as well as using certain coupons or promotions to excel your current positions, are great from using some of the big boys. For example, many banks will offer certain coupons with extra capital if you set up a direct deposit with them, or others offer reduced percentages based on the longevity for your loans and the longevity that you've been banking with them. Banks will be your best bet for holding capital rather than, as you can see below, the shoebox. But we recommend to switch to CDs or credits of deposits at this point. If you have a savings account, we recommend using YADA, a prize-based incentive. We classify bonds and CDs separately as an expense due to the idea that bonds and CDs typically place capital and almost guarantee the principal amount back as more interest grows. This would be way better than sticking your money in under your mattress or maybe in a plastic tub or in your Nike shoebox. Whatever that situation is, we always recommend don't just have your money sitting, have it being working for you. So, what about bonds? Bonds are low risk investments, but still considered an investment, as bonds are legally liable to receive capital if there is a case of bankruptcy. If the situation arises with bankruptcy, then you may have to settle with pennies on the dollar, but keep in mind that there are bond ratings that are out there, and the default rates on a AAA bond is 0%. On a AA bond is 0.38%, and a single A bond is 0.39%. When you get into the riskier segments, you're going to be looking at triple B bonds with the default rate of 1.02%. which means that that's the risk rate of the bond and its ability for it not to pay you back. To start with the Excel sheet, now we want to go on to loan payments. For say there's checking and savings. Savings accounts gives you a return. That's what a savings account is. Your checking account is what your spendable capital is. You have YADA, prize-based savings, CDs as we just talked about, index funds and bonds. A greater saving platform and better returns than banks. Most banks offer you 0.05% savings accounts, but if you decide to go with an index fund, you can look at anywhere ranging from 3 to 5% in the markets, sometimes even 8% depending on the years, or bonds, many other opportunities that arise with that. Now, what about loans? Many individuals find themselves in debt or use debt as a means to obtain further capital. What happens if you have personal loans, friend loans, credit card consolidation loans, purchase loans, layaway programs, anything that is in the loan category except for school loans, car loans, house or mortgages is what we include in the loans section. What about an investment in the stock market? As we hold true to the principle of whatever you invest in the stock market, keep the mindset that you will expect nothing in return. Shoot for the stars and accept the ground level. Maybe you invest in a business monthly or yearly and you want to depreciate the investment. What about a new countertops for your house that grows with the value because you did your countertops? Now your house value just raised a few $1,000s on top of what the expenses were to do that. Investments are classified to us as anything that has a potential negative impact towards your goals, most of which are long-term positive impacts towards capital growth, but some do go bad. What about real estate, stocks, friends, loans, business loans? You invest in art, luxury good, housing projects, hobbies, anything that could return a positive return. Just shoot us an email and we're happy to better answer your question about what category should pertain to what your question asks. So, things to look out for when you're looking at loans is there's high interest rates, upfront fees, and the likelihood of being able to afford after you complete your budget. Will you be able to afford that car payment loan of $1,000 or $500 or $200 after you realize how much you actually have in spendable cash? Just some small micro things to keep in mind, and especially with the high interest rates. Banks and other corporations love to get you there. As the investments that we talked about, expect all of your investments to lose. The types of investments like we talked about. You want to invest in the art, the house projects, the hobbies, the real estate. But keep in mind the best investment is always to invest within yourself. Now we move on to the retirement section. The 401k or the Roth 401k. Companies match. That's something to keep in mind because it could be dollar for dollar, or your employer will contribute an amount based off of the amount that you contribute. Typically, a specific percentage of capital that you devote. They cap it to a certain point of your salary and do an XYZ percentage based off of your salary. This is vital to maximize if you're able to spare the extra capital. It's free money. That's something that you really should understand. If your company matches it, it's free money. Also keep in mind, it's all a tax-deductible saving. So, retirement accounts we'll talk about a lot further in the section below, but retirement accounts are matched to a certain dollar amount, and you're not able to touch that amount of capital until the age of 59.5 years old. What about your security structure and your future? This is what retirement seeks to do. What keeps you going. You want that $1 million house on the beach once you retire because you've been working hard for the past 40 or 50 years of your life. Think now, thank yourself later. Start saving now because this will go a lot further in your life than what you can think about. As we'll learn further on in the retirement section, there's rules like the rule of 72, how much it will take or how long it will take to double your money within the markets. It's free money. If your company offers it to you, definitely take up on it. Budget in to maximize your retirement benefits. Next, we have school loans. Everybody wants to achieve a higher level of education. Some don't, but most individuals seek to achieve a higher level of education because it promotes you further in your job growth. It could promote your salary a lot larger. Whatever the situation is, most of us typically seek to take out a loan for success in school. There are different types of loans, education-based loans, banking loans like FAFSA, bank loans, plus loans. Every institution offers a student loan. Interest rates tend to be around 5% or less and promote you to higher capital growth opportunities. What I mean by that is a typical labor job may bring in $25,000 a year. If you have a associate's or a bachelor's degree, or maybe you took on trade school, you're able to use that to your benefit to grow your wages. Thus, you could be having a $50,000 job, doubling the amount of capital that you would have received without furthering your education. Also, keep in mind that with Biden as president, there's a lot of debate and talk about the chance of a loan reduction or free education that could be coming to the table very soon. So, credit cards. You'll learn more about credit cards in the credit card section that we have developed below, as well as you're able to get a one-on-one conversation with one of our professionals to see which credit card may be best fit for you. So, hopefully you haven't found yourself in an immense amount of debt already, or you're just starting out trying to get credit cards or grow your personal wealth. With that, we always recommend using credit cards extremely careful and cautiously, as you need to understand the mindset going into credit cards as well as the benefits that can come with a properly used credit card. So, minimal payments on credit cards typically are around $25 at the low, and ranging depending on how much the bank requests or financial institution requests back from your credit card. This could be from late payments, they raise that up. Otherwise, you're looking at an average around $25 for minimal payments. Credit cards also come in and they open opportunities saying, here's $1,000 credit limit. Make sure you're in the right mindset and able to move forward with that. You have to really understand that you don't have $1,000 now. You have the ability to purchase up to $1,000 of good per month as long as you pay that amount back. You're borrowing money. It's basically like an open line saying, hey, at any time, here's $1,000 that you can tap into. But we recommend not tapping into all of that at one time. Or maybe you want to, and you want to credit card churn, or look at understanding you need a big purchase, so you jump on that. Whatever the situation is, just make sure you're in the right mindset when you go into credit cards, as well as being in the proper headspace, like mindset, with purchasing and understanding truly what you're getting yourself involved in when you move forward with that credit card. There are many interest rates ranging on credit cards. It's something to keep in mind a ton. Some offers may be 0% down for 12, or excuse me, not down, but 0% interest for 12 months, 18 months, 6 months, 3 months, whatever the situation is. So, interest rates range from 19 to 23% on average APR. Some now are going up to the 25% threshold, but we don't recommend ever falling in the trap of needing to use or jump on interest rates. With that being said, now you have a credit card of $1,000 credit limit, and you decide that you go out and spend a TV for $500, and you decide to spend on $500 on a new electronic device, and you realize, oh wow, I only have $100 in my bank account, but this credit company decided to give me $1,000, because that's how they trap you in on a lot of these things. Well, you have to understand that if there's no benefit towards going forward with that, your interest rates are going to now come in and destroy you, I guess, in the best way to put it. So you have $1,000 bill you can't pay, but you can pay the minimum payments of $25 or $100. Well, theoretically speaking, if their interest rate's at 20%, you're going to be looking at owing $200 back on that credit card per year, just based off of the fact that you got trapped into their famous, lovely traps that they do. And that's going to bring you into a pitfall of debt as well as a continuous cycle. And so we always recommend getting out of the perpetual cycle of debt. You get trapped and you get stuck. But one thing that I would like to bring up and to make aware is, isn't it crazy that somebody can give you, let's say, a $20,000 loan for school? You turn 18 years old, you get $20,000 plus for school, and you start racking up school debt. Then you decide, hey, I want to build up my credit score, so you get one, two, maybe three credit cards eventually over the course of your 4 years of education, ranging, let's say, $35 to $5,000 credit limits on these credit cards. But before you even have a job, before you're even 20, 21, 22 years old, you're already 25,000 or so dollars in debt. And isn't it crazy? That's the trap that we talk about. The banks, they really like to give, and then now you owe basically your life to these banks. They're going to call you nonstop saying, hey, where's our money? And if you fall in a trap of that. Otherwise, most individuals can really understand, all right, well, I have to associate $350 or $500 aside for my school loans, and that is just automatically, I'm taking that out of my bank account and dumping that into the school loans. And some may not even fall under the credit card trap. They have the $3,500 or $5,000 loan or credit limits, excuse me, that are out there, but they're only using the 20% threshold or the 30% threshold, or the credit card churning, getting a rebate of $200 back on there. But I just want to keep that in mind because it's something that could be very scary for many individuals. You fall into the trap, you start spending, and not being able to repay or put that money back, because that alone, $25,000, that's a labor job 40 hours a week in most locations within the US per year as a salary, minus all the other expenses that you may have. So you find yourself needing to work now another 2 years just to pay everything back when they already grabbed you and took you down this dark rabbit hole. So, savings, like we talked about earlier, you gotta realize your savings. There's applications like Yada Bank, which we really recommend. That's savings with an incentive. We're gonna have an affiliate link as well within our course moneymaker description or course segment. But Yada Bank, a brilliant application with saving-based incentives. Next, there's savings accounts within the banks. But like we talked about earlier, invest in index funds instead of just having your money in a savings account. Maybe you wanted to invest in precious metals like gold, silver, platinum, hard commodities that you can hold on and know that they're yours. We always recommend doing anything other than letting the banks turn your money on you. Because what happens when you put your money in a savings account is the banks now have access to the $100 and they can go and invest it elsewhere, give it out either in loans, maybe they can give it into the stock market, whatever that situation is, they're turning money on you and only giving you 0.05% or a little bit more or less. And that's why we always say go with credit unions as well. You may be able to get 1% APR back on your savings accounts, whatever the situation is. We as Laguna Eye Capital will keep our eyes open for you and send you a monthly report letting you know what incentives are out there and what good applications are great to use, as well as walking you through and possibly giving you more and more opportunities to get your savings accounts up and grow your wealth. With that being said, now we go to the Laguna Eye Capital segment. So, the fund. What is the fund? Well, the Laguna Eye Capital Fund is a collective service at the end of the year that gives you everything that you put in plus a little bit more. We want to be the ethical individual. We want to give you back what the market returned for us. We want to give you opportunities to grow your capital and as well as hold you accountable to saving and different things like that. So, it's $5 a week, minimum deposits, and that's just the minimum. You're able to deposit more. But $5 a week is a great start for everyone at the end of the day to start moving forward with. So we return all of that back at the end of the year during the holiday seasons. Maybe you jumped in halfway through the year, whatever the situation is, we always reimburse at the end of the year. And we give you what we made in the markets, or we give you what we made in our investment opportunities and savings accounts that we have for ourselves. So you're not going to be getting the 0.05% anymore. Now you may be getting anywhere from 10% on the extreme high to anywhere from 1%. Whatever the situation is, you're always going to get your principal amount back plus a little bonus. So if you were to invest starting January all the way till the end of December, you're looking at roughly $260 plus, depending on the minimum amounts that you put back. And that's just from our fund. So invest and save as much as you feel like. If you want to put aside $100 a week, if you want to put aside $5 a week, whatever that situation is, always remember that your money put aside now that can grow and increase with the markets, or increase with the individuals that we decide to invest in, whatever that situation is. Investing and putting money aside now will always grow your capital and wealth in the future. So for further information on that segment, or to understand the Laguna Eye Capital Fund, we'd love for you to fill out an application on our website and get you started so that we all can work to promoting and growing our own personal wealth. Thank you very much, and we look forward to working alongside of you if you decide to go with the Laguna Eye Capital Fund. And always, think now, think later. Thank you. All right, hello and welcome to Laguna Eye Capital segment on banking. So we're in the budget time Excel sheet right now, and we're going to start off with the loan payments. Maybe you owe somebody a couple $100 here, another friend a couple $100 there, whatever the situation may be, maybe a personal loan that's out there, whatever the situation is. Let's include this in the banking section. So we're going to toss in $800 here. Now keep in mind, if you owe a mortgage, or maybe you owe a payment on a car, whatever that situation is, we're going to include that in the house section as well as the transportation car payment section. So you decide that, hey, I'm going to invest $400 because investing now is going to set me up for an excellent future. So we're going to put aside $400 there in the investment section. Next, you think about your retirement accounts. Well, okay, I'm going to put aside $400 here, as you will learn further on in the retirement section how much or how valuable it is to put aside money depending on how old you are, what age you are, and set a goal of how much you would like to retire with, and figure out how much you need to put aside every single month, year, week, whatever the situation may be for you. Next, we're going to move on to school loans. Say you've figured out how much you owe with your school loan account, so we're going to put in a whopping $250 there per month, and we're going to just base this. The higher you pay off your loans, the better the situation is for you in the long run. So just remind yourself always to get out of debt. That is the key and most important aspect. Let's say that you fell behind in the credit card trap, and next thing you know, you're owing $75 on credit card interest, which is outrageous, but hey, it's $75 down the drain every single time. So I would always recommend trying to conquer your debts first, because that is the most important thing to move forward with. Next, we're going to look at emergency funds. You put some money aside just in case if anything were to happen, a loss of job because, for say, COVID-19 decides to come around, or maybe an emergency fund so that if you break a leg or you have whatever the situation may be, just for an emergency or rainy day fund, as some people like to call it, we'll put aside $50 there. Next, you want to put aside just pure savings. This could be in the Yada Bank, this could be in putting aside money for bonds, this could be putting aside whatever amount of capital aside. Maybe you want to move forward with the Laguna Eye Capital Fund, which would be located one column below. So we're going to look at savings. So we're going to rack in about $30, $1 a day keeps the savings man away, I guess. Then we're going to look at the Laguna Eye Capital Fund, 4 weeks in a month, your minimum deposit of $5. We're going to enter $20 there. Then we're going to hit 0 and 0 because maybe you have other situations, but that pretty much covers majority of the banking segment. So we move over to the expense summary now, and we're going to take a good look there, and we're going to see that, oh wow, my banking cost me a whole lot more than what I really thought I was putting my capital aside for. Well, that's really the situation that may come in hand. All of those loans, all the debt, we're going to call the investments in the 401k retirement accounts as expenses because you're going to put that away, but soon it will become income as you slowly get older than these 59.5 years of age, and that's going to be coming income back into you. So look at it as an expense now so that you can really understand where your financial situation may lay or lie. So we're looking at banking right here. So far we have a cutout of roughly about, looking at your expenses and everything, your banking alone is 21% plus. These are just averages, these are just estimates of random situations that may come about for certain individuals. So just keep that kind of stuff in mind and realize that banking, getting out of debt, is the most important. And from this example you can see having $0 in the bank account is a whole lot better than having $500 in debt, because maybe interest may accrue on the debt that you have within there. So this is just a good example to move forward with, and this is just really just to break the underlying effects of what banking is for you, and just to give you an example of how to fill out your budget time Excel sheet. Thank you very much, and now on to the next section.